So the same playbook that the Fed rolled out as a stopgap to the liquidity squeeze that was driven by banking failures in first quarter and into Q2. We saw it with First Republic as well. Um, the solution was the BTFP, right? Same thing here, right? If we need to support 10-year, 20-year, 30-year, we need to prevent the rates from spiking, right? Well, just to provide liquidity support to your dealers, what you can do is open a facility where your dealer posts their bonds that they're holding and that they need to make a market in. They post those. You post a 10-year or 30-year Treasury earning, 4.5, or maybe it blows out into the 5 level that, you kind of see on the charts as a key level that gets defended. Let's say you own that debt, you're holding it and inventorying at 5%, let's say, and your business is you want to make markets in that. You're providing liquidity. You inventory this bond to buy and sell to your counterparties, and that's kind of the nature of your business. What happens is when that inventory starts to sell off, you see the yields blow out in the Treasury curve. What's actually happening there is your market makers are stepping away. They don't want to inventory that bond because the market is moving quickly on them, and that's where they can lose a lot of money. And it's just because they're like anybody else operating in the economy, they're trying to make a profit. They're not going to sit back and just take those losses for charity work, right? So to kind of step in, and it also becomes unhedgeable, right? The Treasuries, the futures market will blow out back off as well. Move, like we talked about, move at the beginning of this live stream. Move blows out, the volatility, which is equivalent to price of these options, starts running away from you. You can't hedge your risk, right? So what do you do as a market maker? You just flip your sign from open to close, you sell, and you step away. So what the Fed could do with a facility to step in, if Treasury market liquidity is your desired objective, like maintaining the functioning of these markets, you can't do it. You can't force your dealers to step in and risk massive losses to their own balance sheets. What you would have to do is incentivize them to keep holding an inventory of these treasuries. So what you would do is open up a collateral window where your primary dealers, your hedge funds, just your broker dealer community, some of these are banks themselves too, but they could basically borrow from a facility on longer duration bonds. With BTFP was more, let's use your front end collateral. You post your long duration treasuries, and then you borrow at the swap rate, similar to what we saw in the borrowing index rate for BTFP. And right now, that swap rate, you'll see the negative swap spreads, right? And they've gone. You'll see these in headlines. If like on Liberation Day you saw a 10-year or 30-year spread, like this curve is massively inverted as well, as opposed to the nominal Treasuries curve, right, which is now positively sloped everywhere except for inside of the front 2 years. We're just waiting for the last 100 bips of cuts on the front end to the Fed funds rate before you see a positively sloped nominal Treasuries curve throughout. The swap rate is actually massively negatively sloped. So the more you go into the future, like a 10-year or 30-year reference rate, your swaps are technically pricing like at least 75, maybe getting close to 100 bips below the nominal Treasury curve the further out you go. So that massively inverted swap spreads curve is actually kind of incentivizing. It's set up very well for this liquidity support to come in the next time it's necessary. So that'd be mine. Like if you're trying to read the tea leaves or see around the corner for what might be coming next, the next time we get close to the situation where we need the referee to ring the bell, get saved by the bell, kind of like we were with the Trump tweet announcing the 90 days extension this past Wednesday. The next time around, the push comes to shove. This would be like the type of move you see announced on a late Sunday evening to come in and support. And depending on the volume or the size necessary, this would, in my opinion, fill in at least the next bout of illiquidity. The next time this rears its ugly head and becomes a problem, which in my kind of skepticism is more of a like when, not if.